We all know the 2024 election is right around the corner, and there's potential for a shakeup in the stock market as a result. Big events like Fed decisions, elections, and earnings can create serious uncertainty and volatility for investors. It can be stressful, worrying about how your portfolio will be affected. On top of these major events, there are also global events that sneak up on us that we don't necessarily see coming. These can also catch traders off guard if they're not prepared. Sometimes you'll get a big market moving headline out of nowhere that really disrupts trading action. It could be on the upside or the downside, but regardless, you want to be prepared and know how to react to that. In today's video, I'm going to take you through a pre-event checklist that you should be running through ahead of any known big events. The key takeaway here is you're not helpless. You're not at the mercy of whatever happens. There are definite strategies and things that you can do to protect yourself and really be prepared. So the first thing you want to start with on your pre-event checklist is, what kind of market environment are we heading into this risk event? Is the market in a position of strength, or are we looking weak? A great way of figuring this out is by looking at what IBD's recommended market exposure is right now. 0 to 20% will tell you it's a pretty weak market, while 80 to 100% tells you it's a much stronger market. This exposure recommendation is essentially based on what the market is doing. IBD takes into account many criteria to make this decision, including if the major indexes are above or below certain key moving averages, market action in recent weeks, number of distribution days, if we're in an uptrend or not, and more. Again, we start with the market. What kind of conditions are we in? What are the key levels on the major indexes that we want to watch? Next, you want to be sure that you have your game plan for both positive and negative scenarios that could unfold. Ask yourself, to the upside, what would a bullish scenario look like? Are we nearing a new all-time high for a given index? Then you could hypothesize that a quantifiable positive reaction would mean a breakout to new highs for that index. Then on the downside, you'd ask yourself the same question. What would a bearish reaction look like? Perhaps we'd see the major indexes undercutting their 50-day moving averages in heavy volume. The point is, you want to envision in your mind's eye, where are we today and what the market would look like if we had a positive reaction or a negative reaction. Then, based on that, we need to ask ourselves, what are those portfolio decisions that I would need to make to lean more bullish or lean more bearish? And the key thing to remember is, it's not about taking big swings and going all in or all out. The IBD methodology stresses being incremental. It's important to take the market signals as they come and adjust little by little based on what's happening and what criteria are being triggered. As you may have seen with past Fed announcements, there's often a counter reaction that comes soon after the initial reaction to the news. Perhaps that first reaction is not going to be the ultimate reaction that plays out. The biggest key here is to remain open-minded. There's this tendency to want to place a bet on what's going to happen or what you think is happening, so you can profit off that. But it's much less risky to react incrementally, little by little. And you'll be able to do this well if you're already prepared ahead of time for those different actions that you would take based on what the market does. You're essentially giving yourself if-then statements. If this happens, then this is the action I will take. Now that we've talked about the different levels to watch and different scenarios that could unfold on the index level, let's talk about industry groups and stocks. We talk a lot about rotations and the way that money can rotate from one sector to another. Tech stocks could be leading the market one day, then big money starts to pull out of tech and rotates into industrial stocks or defensive stocks. It's important to have an awareness of what groups are currently in favor right now. Then, based on whatever news event is about to occur, you should also have an awareness of how that might affect where money flows after that. You should have a rough idea of what groups or what sectors might benefit or be hurt by that event. For example, when a big election is on the horizon, it's important to lay out ahead of time which industry groups will benefit from which candidates. There are various ETFs that represent the many sectors and subsectors of the market. Using these as gauges and potential investment vehicles is a great tool to have in your toolbox. Sometimes it might not be clear ahead of time which groups are going to take the lead, so screening stocks and ETFs regularly is critical here. Okay, so now we've built a clear picture of the market environment around us on a broad level with indexes and on a more specific level with sector-specific ETFs and stocks. What's next? Well, now we must take stock of our own portfolios. We must ask if our portfolios are in line with IBD's recommended market exposure. If we're a little lighter on exposure than what's recommended and we're not finding anything to add, that could be more data coming to us about the true state of the market. When there aren't enough breakouts happening, it could signal weakness under the hood. Another way to ramp up exposure when you're not seeing any compelling single stock opportunities is using an index or sector ETF. This way, you're not taking on any single stock risk. This could be a prudent way to participate in a bullish scenario. This brings us to the next part of how to prepare for big events in your portfolio. Let's look at what actions we can prepare to take should a bullish scenario unfold. This starts with making sure your watch list is ready to go no matter what the market is doing. Even if you're in a very slow bearish correction and there are not a whole lot of opportunities out there, always keep a watch list up to date every day. That way, when things do turn around, you're ready to go. You're ready to pounce on this breakout or that breakout, and you're not panicking looking for stocks to buy when a sudden rally is triggered. When it comes to building your watch list, be sure to focus on stocks that are showing relative strength. We want to find stocks that are outperforming because we've found that outperformance leads to more outperformance. These outperforming stocks that are setting up in bases and approaching buy points should definitely be included on your watch list. Next, let's look at what action steps we can prepare to take should a bearish scenario unfold. For each of the stocks that you own going into a risk event, you need to have an exit plan. It may be as simple as using the 7 to 8% sell rule. This is where if a stock is down 7 to 8% from your purchase price, you sell your position because you don't want to be sitting on a 20%, 30%, 40% loss. If you hold a stock that's gone down 50%, then it's going to take you a 100% gain just to get back to break even. So we like using the 7 to 8% sell rule as a basic guideline. But there are many ways you can approach selling. Say your stock has produced solid gains since you bought in. Here, your exit strategy may be to lock in profits should the stock pull back and undercut key moving averages. Just like adding to your portfolio, selling can also be incremental. Scaling out of a position little by little is a great way to approach position management. Another key thing you have to remember when heading into these big events is that there's the initial reaction to the news, but then there's often the reaction to the reaction. Indexes can go back and forth, sometimes rapidly. Things can look really good and the market is moving higher, then for whatever reason, it just completely nosedives. This is a big reason why we scale in and scale out incrementally and why we want to be reactive instead of throwing it all in at once. Just focus moment to moment on what the market is doing rather than what you think it should be doing. If the initial reaction is positive, you may not want to start buying immediately because we could see a downside reversal. Waiting for the dust to settle a little bit can be a good plan. But on the other hand, if we see a big negative reaction out of the gate, don't wait too long expecting a rebound. If you see your stocks continuing to sell off precipitously, you don't want to be a deer in the headlights. So, not too quick, but not too slow. All in all, having a game plan for positive and negative scenarios will help you be more nimble when big news events hit, no matter what the reaction ultimately is.